welcome back, traders and investors. It's that special time of the week where we got Fari Hamzei in to give us his outlook on the market. Fari, right away you picked up that call and you sounded in a good mood. How you doing today?
I'm good. Good morning. Good to be with you. Hi, Kyle. Hi, Joel.
Okay.
Ari, good morning, buddy. You were begging us right in the break there to jump right into the Momo mains. Joel, if it's okay with you, I want to get Fari on some Tesla. I know we touched on it earlier today, but Fari, you're screaming Momo at us. What are you liking in Tesla?
Well, we've been bullish on it from pre-earnings. As you know, we put a call spread on for the EPS trade, and it didn't exactly go our way that day, but during the follow-up, we gave it a 7-day window so that we didn't jam ourselves into it has to be at this price by this date, and it worked out really nice. Unfortunately, we rushed it a little bit. We really could have really cleaned up, given the prices now, because our call spread was 220, 230, and I think we exited on the Tuesday, and the big move was yesterday, right?
Right.
The big move was yesterday, correct.
What
And this has to do with their, the change they're thinking about to do with battery. There was some rumors out there before. I think yesterday it became concrete from what I hear. And again, overnight, it's another 8 points up, string at 261. So it's all-time high.
What did you put
Way
that?
to go, Elon.
What did you put that spread on for?
I think we put it for $1.75, something like that.
Okay.
Our rule is not to go over 30% of the width of the spread. Okay. If you go beyond 30%, that is, you're putting like $4 to win $10. You're setting yourself up to be disappointed. Usually try to get it to maybe 15%, 20%. Our line in the sand is 30%.
Okay, folks, what Fari's emphasizing here and what we try and talk about a lot on the show is risk-reward ratio here. So what he was looking at is he was risking $1.75, and what I like about what he does is he knows that the most that he can make on that is at 8.25. So you are a little bummed that it busted out over 230, but you were in a position where you locked your gain in. You couldn't make more than the difference in the call spread minus the
but there's a
premium.
reason for that.
Go ahead.
The reason is this: if you go through your option chain to pick what the components should be, either outright or spread, you are also looking for some targets. Okay, and we use volatility based sigma channels to look at possible targets out there, and I believe that 227 was our target because that was the day on the day of EPS. 227 was 3 sigma. At 3 sigma, you're looking at 99.97% of travel. So you at 227 we're pushing it. So, but still we said, okay, let's find a spread that makes sense in terms of which these are weeklies. You have weeklies, you have also monthlies. Which is spread that makes sense, that it's under 30%, falls around 227, okay? And the reason we wanted to do a spread was volatility. Volatilities were juiced up the last week, which was the normal expiration, the monthlies. I believe the Tesla right before EPS was like 184, 183 vol. I mean, the only person who makes money at that rate is if you go outright. Outright, the only person who's making money at that rate is the market maker. Why? Because even if the underlying moves your way, the collapse of the volatility the day after. Remember, what matters is the next day. At night, you cannot exit. It's an option, right? So you have to make sure the cash market opens the next day. At that point, the volatility is going to collapse because the unknown is taken out of the equation, right? Now we have EPS. We know what that number is. We have their conference call. We know their guidance. When those are become known, the volatility is going to collapse. So if you don't sell a call higher and not make it a spread and just be outright, you own that volatility, including its collapse. By selling one higher, you squeeze the volatility down so that you increase your chances. It makes sense for that trade to be a call spread.
Okay,
As you see, it's a checklist you go through of how to construct it.
Okay, we're talking about some other Momo stocks here. What else you got on the Fari radar?
Oh, I like Amazon. I like FB, Facebook. Believe it or not, I like Google. Google actually is probably least juiced up stock. Don't look at the value. Look at fundamentals too. What their PE ratio is. I like Netflix. I like let's see, Solar City, another Elon Musk operation. Of course, Tesla. We've been looking at Twitter. Let's see.
While you do, I just want to point out.
I don't know about Priceline. I've never had a really good chance with Priceline, but
what are you looking at on Twitter?
It seems
here?
like.
Are you looking at the long side on Twitter?
Yes.
And another thing that I wanted to point out, which
there's a reason there. This is where the managers are going to be. People who are behind. Remember, we've had a tough January. They're trying to catch up, given where the indexes are arcing right now. We're at 1845 on the cash on SPX. The 2 sigma is 1876. There's a small window here that they can make some money, and it's not going to be an index. It's going to be these Momo names.
Okay, all right.
That's why you see the activity there. See, you got to justify where the activity is to understand the phenomenon that's happening.
And the other thing that you did on the Tesla, I think, which is important to point out, is that you gave yourself another week. The earnings came out last week, but you said, hey, you're not going to pin yourself down. You're going to give yourself a little bit more time. Since you were on the premium end, selling the option here, you bought yourself a little bit of protection. And I think a lot of times these weeklies are very enticing, but then a lot of times the move the pinning that goes on, the moves take place the following week. So that's another important thing in Fari's strategy I wanted to point out.
Joel, here's another way of looking at it. If let's say the EPS is on Wednesday, okay? Wednesday. And let's stay just with weeklies, okay? To make it simple. The EPS is on Wednesday. So it's going to report after the close on Wednesday. All high techs do. Okay. You have 2 days to go. There are times you could find something good for the 2 days. Those you really need to push up in terms of where the sigma levels you're looking at. And those maybe you could take outright. All right? Now, the very few names will respond to that. One of them is Google. Now, what happens to that trade? That trade becomes what we call lotto. You do it outright. You don't do a call spread. You just buy a call, but high up, way out of money. Okay, so only big names could respond to that. Apple possibly can, Google can. But then, what else you need to do? I would suggest you do a 2-day outright call, but then also put a secondary trade on, a call spread for a week forward, just as a backup in case your out of the money doesn't kick in, okay? You'll take somewhere in the middle between where we are and that high target and do a call spread there with a week forward, okay? So you can put 2 trades on. There's no rule how many trades you can put on before EPS, and we've done that. Sometimes both of them hit, very few times. Most of the time, you get disappointed when they're way out of the money because the Sigma channels were pushing it, but the one in the middle kicks in, and you get your 10 points. You get your 5 points.
You get your juice.
Oh. Exactly. I mean, and it also pays for the other trade you did.
Okay, what
Remember,
about
EPS trades are, I usually tell to my room, hey, if you guys had a good day in the futures, take a little bit of that, look at this EPS we're looking at. Why? There is a chance that you could even, for example, with Netflix, And Netflix is an expensive one. You have to be careful with that. But on Netflix, for example, in October, our target was 380. I think the stock was trading 330, 340. Or maybe a little bit lower than that, 320 area. I forget. After hours, after the EPS came out and conference call began, it went to 389, 387, somewhere there.
I remember
Next
that.
morning, cash opens. Guess what? Call icon sells half of his position. Within an hour, we're back to scene of the crime, 320.
Yeah, I remember that. I remember talking to
Yeah.
you about that. So let's just talk a little bit general market here because
Okay.
I think it's really interesting here. I did a little piece on it. Did we have a breakout or a fake out? We had all these highs in the S&Ps. I believe I counted up to like 12 or 13 highs right in the 1845 area. We had the all-time high on December 31st at 1846.50. We barreled through there earlier in the week, rallied up another 10 points. No
Right.
sellers. Buyers got exhausted. Boom, we come right back down. We settle at that all-important 1846 level. 2 days in a row, settle at 1842 yesterday, 1847 high today. What are your Sigmas telling us? Is this a breakout or a fake out?
The more we stay up here, again, this is just experience.
Mm-hmm.
I've been watching this stuff. I've been in front of the screens pretty much from like 95, 96 straight on to now, every day. The more you see it sit like this there's a chance to go to 2 sigma. Remember,
Where's 2
indices
sigma?
don't go
Where's
to
2
3 sigma.
sigma?
That's too far.
Where's 2 sigma?
1876 on the cash.
Are you going to tell us about how you calculate your sigma, or would you have to kill us if you did?
No, we don't have to kill you. No, this is actually, sigma is from Ottoman Empire. It's 400 years old. It's called the standard deviation. Basically, you take a mean. Remember, my background was double E, so I'm dealing with signal to noise ratio. The price action is like a EKG. It goes up and down, moves. What you need to smooth it and take the noise out. Well, one simple way is put a 20-day or 20-bar, we call it, moving average. Okay, you don't want to make it too long because then you create a lag, and you don't want it too short, then it becomes too jittery. But that creates your baseline. That becomes your what we call zero sig. The 20-day moving average, and then you calculate along with that, right? That moment, and as a matter of fact, on charts that are live, like let's say eCigo, TradeStation, what have you, it's computed in real time. As each price comes in, it recomputes, and it projects it what the level should be. And then you take the standard deviation of the 20 days. So you have zero sig, which is the moving average, and you build 3 levels up, 3 standard deviations, sigma 1, sigma 2, sigma 3, and then 3 standard deviations down, -1 sigma, -2 sigma, -3 sigma. Okay, it's no different than expanded Bollinger Band, if you think about it.
Yeah,
right?
it's funny.
But
Violin
the
maker.
key is the rules. The key is not the charts. The key what the rules are. The rules are simple. If we break out, go through a zero sig, okay, and get into between +1 and +2, okay, it's crucial. +1 and +2, we have a chance to move up gradually, and that could go on for a while. And then where's the exhaustion? We go above 2 sigma and we fail. On the index, that's very true. Like SPX, you hardly see 3 sigma. You sometimes you see -3 sigma, like we did February 3rd, first day of trading in February. That was a -3 sigma. Usually when that happens, that's a low.
And it sure.
Because why? On the downside, again, we've talked about this before. You got elevator versus escalator. There's fear involved. During the fear of when we go down, and remember, who is at risk? The longs. How much longs we have? A lot more longs we have than shorts, right? The stock market in itself is long, right?
Correct.
So there's more people are at risk on the downside. That's what creates that cascading push down. We're going to go through -2 sigma, like hot knife through butter, and we hit 3 sigma, and you'll see prices stop. There's no magic. You just have to concentrate. I don't pull these numbers out of the hat. I look at a chart. I'll see what the sigma levels are. I call into a room. I say, guys, at this level, we're going to start covering our shorts.
Right.
I think the reversal is coming. Now, you'll have a day or two maybe of hesitation. That's normal. But you'll see, and how do you see it? It starts separating from the negative 3 sigma. Negative 3 sigma still keeps on going down, but the price isn't.
So
That's your divergence.
Fari,
There's your turn coming. At that point, you start buying some, let's say, SPY options. Why? Because nobody can pinpoint the highs or the lows, and we're not in that business. We're in the business of taking 70% of the chunk in between. Okay? And options would be a good tool. You have a defined risk, and you have a little bit of time. So you're not going out there trying to bet with futures and get your ass kicked.
Okay, we need to close out the interview here, though, and I really like the point that you made about the longer we hang up here, the more chance you think we're going to bust out to 2 Sigma 1876. I mean, are
Correct.
you looking for today, tomorrow? You know, I mean, we've already hung up here for a couple days. A lot of people jumped in after we Momo guys jumped in on the upside. Can you just give us a quick, I mean, are you looking for today, tomorrow, early next week?
I would look at two things. The known and the unknown. The known is the economic calendar. Who's speaking? Like today, Yellen is speaking.
Yep.
What kind of econ data are we getting? These are the known ones. The unknowns are something like Ukraine.
Okay.
So some of it you have to be on a watch. Some of it, you know what the events are, and then you look at how the market is reacting to it. Remember, it's not the economics. It's not looking at what your econ professor told you. Throw those books out of the window. Look at what the market is doing.
Right. Market.
In light of the news.
Price don't lie. Okay, Fari.
Exactly.
Thanks a lot for coming on again today.
Thanks for having me.
Very lively. Can't wait to talk to you next Thursday. Have a good day.
Same to you, sir.